Welcome to the Deep Dive. Today we're plunging into a topic that, on the surface, might sound like pure accounting jargon. Business combinations and consolidated financial statements. But trust me, by the end of this deep dive, you'll unlock some, well, pretty surprising insights into how the biggest companies in the world truly operate and present their financial story.
Yeah, it's really about pulling back the curtain.
Exactly, on mergers, acquisitions, and those, complex structures behind the headlines.
It's a fundamental area, really. It provides the financial lens through which we view these vast corporate empires. We'll unpack why companies, often made up of dozens or, gosh, even hundreds of smaller entities, must present themselves as one unified economic picture.
Right.
We're here to help you understand not just the what and how, but the profound why behind these rules. We'll try and make even the most intricate details easy to grasp.
Okay, let's jump right in there. The core concept. Why? Why do companies consolidate their financial statements in the first place? What's the driving force behind this seemingly complex requirement?
Yeah, that's the perfect starting point. Imagine a massive tree, right, with many branches. Each branch is like a different subsidiary company.
Right.
Consolidation is essentially about treating that entire tree, the parent company, the trunk, and all its branches as a single living organism for financial reporting.
Ah, I like that analogy.
Its purpose is to present the financial position, the results of operations, and the cash flows of a parent company and all its subsidiaries as if they were, well, one single economic entity.
As if they were one company.
Exactly. It's about painting one comprehensive, truthful picture for investors, creditors, and, other stakeholders, instead of just showing fragmented snapshots of each individual branch.
Because those snapshots alone wouldn't tell the whole story.
Precisely. Without consolidation, you'd only see isolated pieces. That wouldn't accurately reflect the true scale or the interconnectedness or even the financial health of a large business group.
So it's all about transparency and giving that complete unified view. And typically the most straightforward way for this consolidation to kick in is when one company, the parent, gains control over another. How was this control usually defined under the traditional voting interest model?
You're absolutely right. Under U.S. Generally Accepted Accounting Principles, or GAAP, the most common trigger for consolidation under what's called the voting interest model is indeed control.
Right.
And this typically means an investor, which then becomes the parent company, acquires more than 50% of an investee's voting stock.
Okay, over half the votes.
Yep. When you cross that 50% ownership threshold, you're generally presumed to have a controlling financial interest, and consolidation becomes a requirement.
So in most cases, if you own more than half the voting shares, you're effectively, well, running the show, and you have to consolidate. Sounds relatively clear-cut.
Mostly, yes.
Are there any general rules about which majority-owned subsidiaries must be consolidated? Like, does it matter where they are?
For the most part, it's pretty straightforward. It's a foundational principle in GAAP. All majority-owned subsidiaries, whether they're domestic operations right here in the U.S. or foreign entities operating abroad.
Oh.
They generally must be consolidated. It's not really a choice. It's a requirement to provide that comprehensive view we just talked about.
Right, not optional. But of course, in the world of finance and accounting, there are always those crucial nuances, exceptions.
Always.
What if a parent company owns over 50% but doesn't truly have the ability to exercise control in a practical sense? Are there situations where that majority ownership doesn't lead to consolidation?
Absolutely. That's a critical distinction. Even with majority ownership, consolidation is not required if there's significant doubt about the parent's ability to actually control the subsidiary's financial and operating policies.
So the power isn't really there.
Exactly. This typically arises in very specific kind of challenging situations where the parent's control is severely limited or compromised by, external factors.
Like what sort of situations?
Well, one common scenario is when the subsidiary is undergoing a legal reorganization, like bankruptcy.
Oh, okay.
Court involvement.
Right. When a company is under court supervision, legal proceedings often impose severe restrictions on its operations and its management's decision-making power. So in such a case, even if the parent owns, say, 70% of the voting stock, its ability to direct the subsidiary's activities is effectively removed by court order. The court's in charge, not the parent. That makes sense. The parent isn't really in control anymore.
Precisely. Another instance is when the subsidiary operates under severe foreign government restrictions.
Okay.
Imagine a situation where a foreign government implements Pervasive regulations that prevent the parent from freely transferring assets out of the subsidiary, or from setting key operational policies, or maybe even from appointing key management.
So the government is effectively blocking the parent's control.
Exactly. These restrictions can be so profound that they block the parent from exercising the practical control that would normally come with majority ownership. In these specific circumstances, despite owning over 50%, the parent wouldn't consolidate because it doesn't genuinely control the subsidiary's destiny.
That makes perfect sense. Control isn't just about the percentage on a stock certificate. It's about the practical ability to, well, run the show.
Couldn't have said it better myself.
Now, when a parent company acquires, say, 60% or maybe 80% of a subsidiary, there's still a portion of that company that the parent doesn't own.
Right.
How is that unowned piece accounted for within the consolidated financial statements?
Right.
What happens to the other 40% or 20%?
That's precisely where the concept of the non-controlling interest, or NCI, becomes vital.
NCI. Okay.
When a parent company acquires more than 50% but less than 100% of a subsidiary, the remaining portion, like the 40% in your 60% example, belongs to other shareholders. These are the non-controlling shareholders.
So if parent co buys 60% of subco, that remaining 40% isn't owned by parent co. But it doesn't just disappear from the consolidated picture, does it?
No, absolutely not. It can't disappear.
How is that distinct ownership slice presented then?
That 40% is the non-controlling interest. It represents the portion of the subsidiary's equity, its net assets, that is not attributable to the parent.
Okay.
Now, in the consolidated financial statements, the NCI is reported at its fair value. This is a crucial detail. It's not just a proportional share of the subsidiary's, say, book value.
Right. Not book value, fair value.
Fair value, as part of the overall entity. And critically, it's presented directly within the equity section of the consolidated balance sheet, but it's clearly shown separately from the parent's own equity.
So it's inequity but distinct.
Exactly. This distinct presentation ensures that while the subsidiary is fully consolidated, remember, 100% of assets and liabilities come in the ownership split is transparently disclosed. Everyone sees who owns what portion of that subsidiary's equity.
That distinction is key. A complete and transparent picture for stakeholders. Okay, so that covers the traditional control model, primarily driven by voting stock ownership. But here's where it gets truly counterintuitive for many. Consolidation isn't always about owning shares. Sometimes control comes through economic influence, even if you don't hold a single voting share.
Right, this is where things get interesting.
And that brings us to the more complex yet incredibly important variable interest entity, or VIE model. What exactly makes a VIE different from a regular company?
You've hit on a critical point. The VIE model addresses situations where a company might have effective control over another entity without holding a majority of its traditional voting shares. A variable interest entity, or VIE, is a legal structure. It could be a corporation, partnership, trust, LLC, whatever.
Any legal entity.
Pretty much any legal entity used for business purposes that has a specific vulnerability, let's say.
Vulnerability, how so?
Generally, a VIE is identified by one of two core characteristics. First, it might be structured in a way that it simply doesn't have equity investors with traditional voting rights, so there's no clear majority shareholder to point to based on votes.
Okay, no voting control possible.
Or second, even if it does have equity investors with votes, it lacks sufficient financial resources, enough equity to support its own activities without needing outside help. It needs outside financial support to stay afloat.
So it can't stand on its own 2 feet financially.
Exactly. These entities are often specifically designed for purposes like securitizations or specialized financing, where the risks and rewards are distributed very differently than in a typical corporate structure.
Okay, so who consolidates these VIEs then, if it's not about votes?
Good question. For VIEs, the entity required to consolidate it is not the one with majority voting interest, but what we call the primary beneficiary.
The primary beneficiary, okay.
This is the entity that possesses two crucial elements of control. First, it has the power to direct the activities of the VIE that most significantly impact its economic performance.
So they're calling the important shots.
They're calling the shots on the things that really drive the VIE's financial success or failure. And second, this same entity either absorbs the expected losses of the VIE, meaning it's on the hook if things go wrong, Or R, it receives the expected residual returns of the VIE, meaning it benefits most when things go well.
Power and economic exposure, both.
Power and significant economic exposure, yes. It's about who has both the power to direct and the significant economic stake, either the potential losses or the potential gains.
Okay, so it's not a choice between the voting interest model and the VIE
Right.
model then. It's like a specific order.
Exactly. That's a crucial passkey in U.S. GAAP. All consolidation decisions are first evaluated under the VIE model. You always start there.
Always VIE first.
Always. Only if, after applying the VIE criteria, consolidation isn't required under the VIE model, do you then move on to assess the traditional voting interest model, the over 50% ownership rule.
Wow, okay. So it's a hierarchy. You look at the VIE rules first. If consolidation isn't required there, then and only then do you check the voting interest model. That's an aha moment for many, I bet.
It really is. This sequential approach ensures that companies can't just use complex structures to avoid consolidating entities they effectively control through economic means, even if they don't hold the majority voting stock. It's designed to capture the economic reality of control.
Got it. Economic reality over just legal form sometimes. So before you even get to determine if an entity is a VIE, you first have to figure out if your company even has a variable interest in that entity to begin with.
That's right. That's the initial filter.
What kind of relationship or stake qualifies as a variable interest? What are the conditions?
Right. So to even be in the running, you need to check off a few things. All 5 of these conditions actually must be met.
5 conditions. Okay.
1, your company and the business entity have some kind of arrangement. This is defined pretty broadly. Could be formal, informal, contract, whatever.
Okay, some connection.
2, the business entity is a legal entity. Corporation, LLC, trust. Even a majority-owned sub can be evaluated here first.
Right.
3, the business entity fails to qualify for an exclusion. Certain types of entities, like nonprofits, employee benefit plans, registered investment companies, things like that, are generally not subject to consolidation as VIEs.
So standard business entities usually count.
Usually. 4, your interest is more than insignificant. Basically, your stake has to be large enough that you could potentially be the primary beneficiary. It can't be trivial.
Makes sense. And the last one?
5, your company has an explicit or implicit variable interest in the entity. This is key. It means you must be positioned to absorb some of its expected losses or receive some of its expected residual returns.
So you have skin in the game, financially speaking.
Exactly. It's about having a financial stake that fluctuates with the entity's performance. You're linked to its ups and downs.
So it's like a screening process, a checklist, to see if you're even potentially involved enough to worry about VIE rules.
Precisely.
Once you establish you have a variable interest, how do you determine if the business entity itself is actually a VIE? What are the characteristics, the telltale signs?
Right. So once you pass that initial check, you look at the entity itself. Does it have the characteristics of a VIU? There are a few key ones. A very common one is insufficient level of equity investment at risk.
Meaning it's undercapitalized.
Essentially, yes. It means the entity cannot operate on its own without needing additional subordinated financial support like guarantees or other forms of credit enhancement from external parties, from variable interest holders.
Can you give an example of that?
Sure. Imagine little corporation needs a bank loan to operate, but the bank won't lend to it based on its own equity. So a shareholder provides a loan guarantee.
The guarantee props it up.
Right, because that guarantee, which is a variable interest, is essential for its financing. Little corporation is likely a VIE. Its own equity wasn't enough.
Okay, that's clear. What are other characteristics?
Another one is when the traditional equity holders, as a group, lack the power to make decisions or direct the activities that truly drive the entity's economic performance.
So the owners don't really have control.
Right, it indicates someone else might be pulling the strings. Similarly, if the equity holders have no obligation to absorb the entity's expected losses,
They don't bear the downside risk.
or no right to receive the entity's expected residual returns.
They don't get the primary upside.
That's a strong indicator it's a VIE. Because if the equity holders aren't bearing the risk or getting the main rewards, someone else likely is the variable interest holder.
Okay, makes sense. You mentioned one more, something about voting rights.
Yes, perhaps the trickiest but very common characteristic involves disproportionately few voting rights. This is a situation where an entity is automatically deemed a VIE if all 3 of these specific conditions are present.
All 3. Okay, what are they?
One, substantially all of the entity's activities are conducted on behalf of an equity investor. Like the entity exists primarily to serve that one investor.
Yeah, dedicated purpose.
Two, the voting rights of that specific equity investor are small compared to the entity's overall focus on serving that investor. Their vote doesn't match their importance to the entity's operations.
Low vote, high impact.
And three, the voting rights of one or more equity investors are significantly out of line with their obligation to absorb losses or their right to receive returns. There's a big mismatch between voting power and economic interest.
That disproportionately few voting rights characteristic sounds like it could be a real head-scratcher. Can you give us an example that really makes that distinction clear?
Absolutely. It can be confusing. Let's use the Team LLC example from the materials. Imagine Gertie Inc. and Small Inc. create Team LLC to produce gadgets.
Okay.
Gertie Inc. invests the $100,000 and gets 10% of the voting rights. Small Inc. invests only $25,000 but gets 90% of the voting rights.
Okay, that already sounds a bit skewed. 90% vote for 20% of the capital.
Exactly. But here's the critical detail. All gadgets produced by Team LLC are sold exclusively to Gertie Inc. Gertie is the sole customer, the reason Team LLC exists.
Okay. That changes things.
It does. In this scenario, Team LLC is a VIE because it meets those three conditions for disproportionate voting rights.
Let's walk through them.
Okay. 1. Substantially, all its activities are on behalf of Gertie Inc., right? Gertie's its only customer.
Check.
2. Gertie Inc.'s 10% voting rights are small relative to how much Team LLC's entire existence revolves around Gertie Inc.
Check. Low vote compared to operational focus.
And 3. Gertie Inc.'s voting rights, 10%, are significantly out of line with its economic interest. Gertie put in $100,000 out of the total $125,000 investment.
That's 80% of the money.
Right. 80% economic interest, but only 10% of the votes. That huge imbalance triggers the VIE designation under this rule.
Wow.
Now, here's the contrast. If those gadgets were sold at some unrelated third party instead of Gertie Inc.,
Then Team LLC wouldn't exist just for Gertie.
exactly. Then Team LLC likely wouldn't be a VIE under the specific rule because its activities wouldn't be solely conducted on behalf of an equity investor. It highlights how the actual purpose and the economic flow of the entity are really paramount in the VIE analysis.
That example really makes the disproportionately few voting rights concept click into place. It's not just about the votes versus money, but also who the entity serves.
Precisely.
So once a company has determined, okay, I have a variable interest in this entity, and this entity is a VIE based on one of those characteristics, what's the next step? Who actually takes on the responsibility of consolidating it?
Right, so you've established it's a VIE and you have a stake. The next step is to identify the primary beneficiary.
The primary beneficiary again.
Yes. As we touched on, this is the entity that meets that two-pronged test. It has the power to direct the VIE's most significant economic activities, and it absorbs the VIE's expected losses or receives the VIE's expected residual returns.
Power and the significant economic piece.
Correct. It's that dual test of power and economic exposure that determines who consolidates. Interestingly, if one party is set up to receive the returns and a different party is set up to absorb the losses,
Oh, what happens though?
the party absorbing the losses is generally the one that consolidates. The thinking is they bear the primary downside risk, which is a strong indicator of control in these structures.
Okay, loss absorber usually consolidates in that split scenario.
Usually, yes. And it's also worth noting, it's actually possible for an entity to be a VIE but have no primary beneficiary.
Really? So nobody consolidated it?
In some cases, yes. If no single entity meets both the power criterion and the significant economic exposure criterion, perhaps the power is shared or the economics are very diffused, then no one consolidates it. This reflects how some really complex financial arrangements can fragment risk and reward too much to assign singular control under the rules.
That's an important nuance. Not every VIE automatically ends up consolidated on someone's books.
Yeah.
Now, before we move on to the actual acquisition accounting, there's a special note for private companies regarding VIEs. Do they get any specific accounting alternatives here? Any breaks?
Yes, they do. U.S. GAAP provides a specific accounting alternative for private companies, meaning not public entities, not-for-profit entities.
Okay.
They may elect, it's an option, not to consolidate certain lesser entities that would otherwise be VIEs, provided a few specific criteria are met.
What kind of criteria?
Primarily, this alternative applies when the lessee, the company using the asset, and the lessor, the entity owning the asset, which might be a VIE, are under common control. There's a leasing arrangement between them, and substantially all the activities between them are related to those leasing activities. There are also limits on guarantees.
So it simplifies things for related party leases within private company groups.
Exactly. It simplifies reporting for smaller private entities by letting them sidestep complex VIE consolidation in these specific common related party leasing scenarios.
Fascinating how the rules can adapt for different types of entities. Okay, so we firmly established when consolidation is required, whether through, direct voting control or this more complex economic influence via VIEs. Now let's dive into how we actually perform the accounting for a business combination using what's known as the acquisition method. This is where the numbers really start to come together, right? The main event.
Precisely. This is the engine room. The acquisition method is the mandatory accounting standard for all business combinations under GAAP. It dictates how the assets acquired, the liabilities assumed, and any non-controlling interest in the company you bought, the acquiree, are recognized and measured.
And what's the core idea?
The core idea is to bring everything, all of the subsidiaries' identifiable assets and liabilities onto the acquirer's consolidated balance sheet at their fair value on the date of acquisition. Fair value is the key principle.
Fair value on the acquisition date. And how do you determine that critical acquisition price itself? Is it always just the cash exchange, or can it be more complex?
Oh, it can absolutely be more complex. The subsidiary might be bought using cash, sure, but also by issuing stock through debt securities, other assets, or, some combination.
Okay.
The investment in the subsidiary, the cost of the acquisition, is always valued at the fair value of the consideration given by the parent.
Fair value of what the parent gave up.
Exactly. So if you issue shares, it's the fair value of those shares on the acquisition date. If you give cash, it's the cash amount. If the fair value of what's received the subsidiary itself is somehow more clearly evident, that value can be used instead. But usually, it's the value of what you gave.
Fair value again. And you mentioned the acquisition date. How precise is that? Is it when the deal is announced?
No, and this is a very precise and critical point. The accounting for an acquisition begins at the date of acquisition, and that is defined as the date the transaction closes, the date the acquirer obtains control.
The closing date, not the announcement date.
Correct. Not when it's initially announced or agreed upon in principle. This distinction is critical because market values, especially for stock used as consideration, can shift significantly between announcement and closing.
That's a huge detail. So, for example, if TAG Inc. announces on April 1st they'll buy Subco for 1 million shares of TAG stock, and TAG stock price is $10 per share then.
That sounds like $10 million.
Right, $10 million on announcement.
But if the deal doesn't actually close until September 30th, and by then TAG's stock price has risen to $14,
Then the acquisition price is based on that closing date price. It's 1 million shares times $14 per share, so $14 million.
wow. And if the price went down to $7?
Then the acquisition price would be $7 million. It's all about that closing date fair value because that's what accurately reflects the economic value exchanged at the very moment control is actually transferred. Okay, closing date fair value. Got it. Now, when the acquisition happens, the parent company needs to record this new investment in subsidiary on its own books. What about all the costs associated with making the deal happen? Lawyers, accountants, bankers.
Good question. The accounting for these related costs is quite specific, and it depends on the type of cost.
Okay.
Direct out-of-pocket costs, things like finder's fees, legal fees, accounting fees, valuation advisory fees, directly related to the acquisition. These are expensed immediately.
Expense, so they hit the income statement right away.
Correct. They reduce net income in the period they are incurred. The same goes for indirect costs, which are more general administrative costs associated with acquisition activities like salaries of an internal M&A department, also expensed.
Okay. Direct and indirect costs are expensed. What about costs related to issuing stock, if stock was used to buy the company?
Ah, that's different. Stock registration and issuance costs. Things like SEC filing fees for issuing new shares, printing costs for certificates, underwriting fees, these are treated differently. They are not expensed.
Not expensed. What happens to them then?
Instead, they are considered a direct reduction of the value of the stock issued. Specifically, they decrease the additional paid-in capital or APIC account on the parent company's balance sheet.
So they reduce equity directly rather than hitting the income statement.
Exactly. It essentially reduces the net proceeds the company is considered to have received from issuing those shares used in the acquisition.
Let's use an example to make these cost treatments really concrete. Say, big company exchanges stock that has a fair value of $415,000 for a 100% of subcompany. They also pay $35,000 in legal fees for the deal and $20,000 in stock registration fees to issue that stock. What's the overall journal entry look like for big company, roughly?
Okay, good example. Big company would debit investment in subsidiary for $415,000, the fair value of the stock exchanged.
Right, the main asset.
Then, the $35,000 in legal fees would be debited to an expense account, like legal expense or acquisition-related expenses hitting the income statement.
Okay, expense recognized.
And the $20,000 in stock registration fees would be debited to additional paid-in capital, reducing that equity account directly. The corresponding credits would likely be to common stock for the par value of the shares issued, additional paid-in capital for the bulk of the stock's fair value over par, and cash for the $55,000 paid out in fees.
So the total cash outlay for fees is $55,000, but $35K hits income and $20K hits equity. Very specific treatment.
Very specific, yes. You have to track the nature of the cost.
That's a great breakdown. Now, sometimes an acquisition isn't just a fixed price paid on day one. There can be conditions attached, right, where additional payments are made later if certain targets are met. This is called contingent consideration. How does accounting handle that uncertainty at the time of acquisition?
Right. Contingent consideration is quite common. It's an obligation for the parent company to transfer additional assets or maybe more equity interests to the former shareholders of the subsidiary if specific future conditions are met.
Like hitting earnings targets.
Exactly. Hitting certain earnings targets, reaching specific product development milestones, achieving revenue thresholds, things like that.
So it depends on future events. How do you record that on day one?
Crucially, even though the payment is contingent and uncertain on the acquisition date itself, the parent company needs to record an estimate of the fair value of this probable future settlement cost.
An estimate of the fair value of the contingency.
Yes. This estimated amount, the fair value of that contingent obligation, is added to the investment in subsidiary account as part of the total acquisition price calculated on the closing date.
So it increases the initial investment cost.
It does. And simultaneously, a corresponding estimated liability for contingent consideration is created on the balance sheet. This ensures the full potential cost, or at least its best estimate based on probabilities and fair value concepts, is reflected upfront in the acquisition's valuation from day one.
Okay, let's use another example. Big company buys subcompany for $415,000 in stock. But they also agree to pay an additional $85,000 in cash in 4 years if Subco's average income over those 4 years exceeds $50,000 annually. On the acquisition date, BigCo thinks, based on forecast, there's maybe a 50% probability of hitting that income target. How does that $85,000 potential payment get reflected right away?
Okay. In that situation, you'd calculate the expected value, or more accurately, the fair value of the contingent consideration. A simple way to estimate might be multiplying the potential payment by the estimated probability. So $85,000 times 50% equals $42,500. In practice, fair value might also involve discounting that future payment back to present value, but let's keep it simple here.
Okay, $42,500 estimated value today.
Right. This $42,500 is then added to the initial $415,000 stock consideration. So the total investment in subsidiary amount recorded on BigCo's books on the acquisition date is $457,500. $415K plus $42.05K.
Ah, so the investment account is higher.
Correct. And concurrently, a liability account, maybe estimated liability for contingent consideration, is recognized on the balance sheet for that same $42,500.
Got it. So the potential future cost is baked into the acquisition accounting right from the start.
Exactly. The full anticipated cost is captured.
That's a clear way to incorporate future possibilities. So once the acquisition is done, the price is set, including contingencies, the costs are handled, and the initial recording is made. How does the parent company actually account for its investment in subsidiary on its own internal accounting records going forward before consolidation happens? Are there different ways to track it just on the parent's books?
Yes, there are. After the initial recording, the parent company needs a way to account for this investment on its separate financial statements, its internal books. There are 2 primary methods it can use for this internal tracking: the cost method or the equity method.
Cost or equity? But wait, didn't we say consolidation eliminates this account anyway?
Precisely. And this is a crucial passkey reminder. These methods, cost or equity, are only for the parent company's internal accounting. When the consolidated financial statements are prepared for external reporting, the investment in subsidiary account, regardless of how it was tracked internally, is always eliminated. It serves merely as an internal placeholder until the consolidation adjustments are made.
Okay, internal tracking only. So what's the difference between cost and equity?
Under the cost method, it's pretty static. The investment in subsidiary account generally remains at its initial acquisition cost. It doesn't change based on the subsidiary's subsequent profits or losses.
So it just sits there at the original price.
Pretty much. Any dividends received from the subsidiary are simply recorded as dividend income on the parent's income statement when received. It's a very simple but not very informative approach.
Okay. And the equity method.
In contrast, under the equity method, the investment account is much more dynamic. It fluctuates to reflect the underlying changes in the subsidiary's net assets or equity.
How does it fluctuate?
The investment account increases by the parent's share of the subsidiary's net income. So the parent recognizes its portion of the subsidiary's profit directly in the investment account on its own books.
Okay. Income increases the investment.
Right. And conversely, when dividends are received from the subsidiary, they decrease the investment in subsidiary account. They're treated as a return of investment, not income.
Dividends reduce the investment. Interesting.
It reflects the fact that dividends are distributions of the subsidiary's equity, which the parent has already recognized through income pickup.
What's fascinating here is how the equity method, even though it's just for internal tracking before consolidation, provides a more current reflection of the subsidiary's performance directly within the parent's investment account.
It does.
Which, as you hinted, might actually simplify the later process of preparing those consolidated financial statements, right? Because the internal books are sort of keeping pace.
Exactly. The equity method keeps the parent's investment account more aligned with the underlying subsidiary equity, which makes the elimination entries during consolidation a bit more straightforward, especially regarding post-acquisition earnings. It gives a more dynamic internal picture.
Can we see that with an example? Let's use Gertie Corporation again. Say it acquired 100% of Linto Corporation for $2.5 million on January 1st. In that first year, Olinto reported $350,000 net income and paid $150,000 in dividends. How would Gertie's investment account look at year-end using the equity method?
Okay. Gertie starts with the $2.5 million investment cost on January 1st. During the year, Olinto earns $350,000. Gertie picks up its 100% share of that income, so the investment account increases by $350,000.
Okay, up to $2.85 million.
Then Olinto pays $150,000 in dividends. Gertie receives its 100% share. Under the equity method, this dividend reduces the investment account, so subtract $150,000.
Right, return of investment.
Exactly. So by December 31st, Gertie's investment in Olinto Corporation account on its internal books would be $2.7 million. That's the $2.5 million start plus $350K income, $150K dividends.
$2.7 million. It definitely gives a much more dynamic internal picture of the investment's value compared to just leaving it at $2.5 million under the cost method.
It does. And while both methods are allowed internally, the equity method often makes the consolidation math cleaner later on.
Okay, great. So all those previous steps, understanding what triggers consolidation, control, VIEs, calculating the price, fair value, closing date, cost, contingencies, and tracking the investment internally, cost versus equity, they all lead us here to the main event, actually knitting together the financial statements.
The consolidation itself.
How do we transform those separate financial books, the parents and the subs, into one seamless financial story for external reporting? What's the core principle driving the consolidation adjustments?
The core principle under the acquisition method, when consolidating, is that 100% of the subsidiary's identifiable net assets acquired, assets minus liabilities, are recorded at their fair value on the acquisition date.
100%, even if the parent only bought, say, 60%.
Yes, absolutely critical point. You consolidate 100% of the subsidiary's assets and liabilities at fair value, regardless of the parent's ownership percentage. The non-controlling interest share is then carved out within equity, but the assets and liabilities themselves are fully brought in.
Okay, 100% at fair value.
And any remaining balance of the acquisition price plus NCI fair value, after allocating fair values to all identifiable net assets, creates goodwill.
Right, the goodwill piece.
Also, another core characteristic we need to remember is that when companies are consolidated, the subsidiary's entire pre-acquisition equity structure, its original common stock, additional paid-in capital, and retained earnings, often called CARR.
CARR, okay. Common stock, APIC, retained earnings.
That entire CARR balance is eliminated from the consolidated statements.
Well, eliminate it.
Because in the consolidated view, the subsidiary isn't presented as a separate ownership entity with its own historical equity structure. Its assets and liabilities are now part of the larger consolidated entity. Consolidated equity will ultimately just be the parent's equity, plus any non-controlling interest if the parent didn't acquire 100%. The sub's own CRR disappears in the consolidation.
Got it. So we essentially strip out the subsidiary's individual equity structure, CAR, eliminate the parent's investment account, and incorporate the sub's assets and liabilities at their full fair value. To achieve this single entity view, you mentioned a series of consolidation adjustments are made, often on a work paper using something called the Eliminating Journal Entry, or EJE.
Exactly. The EJE is the mechanism.
This sounds like the real engine room of the entire process. Can you walk us through these key adjustments in the EJE? What does each step accomplish?
Absolutely. The eliminating journal entry or entries really transform the separate financial statements into that consolidated view. It's where the magic happens, so to speak. Let's break it down. First, as we just said, we eliminate the subsidiary's pre-acquisition equity, CAR. We debit the subsidiary's common stock, debit its APIC, and debit its retained earnings as they existed at the date of acquisition. This removes the sub's historical equity from the combined picture. If you're working with later financial statements, you might need to calculate what those balances were back at acquisition date.
Okay, CAR gets zeroed out via debits. Step 1.
Second, we eliminate the parent's investment in subsidiary account. This account on the parent's books represents its ownership stake. We credit this account in the EJE to remove it. By eliminating both the sub-CIR and the parent's investment account, we avoid double counting the subsidiary's net assets in the consolidated balance sheet.
Right. Investment account credited out. Step 2. Prevent double counting.
Third, if the parent didn't acquire 100% of the subsidiary, we create or recognize the non-controlling interest, NCI. We credit NCI for its fair value at the acquisition date. This represents the fair value of the portion of the subsidiary owned by the other non-controlling shareholders. It establishes their claim within the consolidated equity section, presented separately from the parent's equity. Its value is typically calculated as the total fair value of the subsidiary multiplied by the NCI ownership percentage.
Okay, NCI credited in, showing the minority share at fair value. Step 3.
Fourth, we adjust the subsidiary's balance sheet accounts to fair value. This is often called the balance sheet adjustment or fair value adjustment. We debit assets that increased in value and credit assets that decreased, and do the opposite for liabilities to bring the subsidiary's entire balance sheet from its book value to its fair value as of the acquisition date. Remember, this adjustment applies to 100% of the assets and liabilities, regardless of ownership percentage.
Adjust everything to fair value. 100%. Step 4.
Fifth, we record any identifiable intangible assets at fair value. These are things that might not have even been on the subsidiary's books before, like customer lists, patents, trademarks, brand names, even in process R&D. If they meet the definition of an asset, separable or arising from contractual legal rights, they get recognized at fair value via a debit in the EJE.
So find and record hidden value in intangibles. Step 5. What kind of intangibles are we talking about here?
Oh, a wide range. Agreements, contracts, customer relationships, non-compete agreements, patents, trademarks, internet domain names, computer software, databases, even that in-process research and development we mentioned. GAAP requires recognizing them if they're identifiable.
Okay. And how are they treated after recognition?
It depends. These intangibles are further categorized. Those with a finite life, like a patent with a specific expiration date, are amortized, expensed systematically over their useful life, and also tested for impairment if indicators arise. Those with an indefinite life, like certain strong brand names that are expected to generate cash flows forever, are not amortized but must be tested for impairment at least annually.
Finite life, amortized, indefinite life not, but both tested for impairment.
Got it. Any breaks for private companies here?
Yes, there's another private company accounting alternative here. They can elect not to separately recognize certain intangible assets that often arise in acquisitions, like non-compete agreements or certain customer-related intangibles that cannot be separately sold or licensed. If they make this election, the value of those intangibles just gets lumped into goodwill instead. It simplifies things.
Okay, another simplification option for private firms. Now, step 6 of the EJE.
Finally, and often the biggest piece, step 6, is to recognize goodwill, or potentially a gain. This is usually the plug figure that makes the whole EJE balance.
Oh.
The plug figure. How does it work?
Goodwill. If the fair value of the subsidiary, which is the acquisition price paid by the parent plus the fair value of any non-controlling interest, is greater than the fair value of 100% of the subsidiary's net identifiable assets after all the adjustments we just made, that excess amount is recorded as goodwill, an intangible asset, via a debit in the EJE.
So goodwill is the premium paid over the fair value of the identifiable stuff.
Exactly. It represents things like expected synergies, the value of the assembled workforce, good reputation things that have value but aren't tied to specific identifiable assets. Goodwill is generally not amortized but must be tested for impairment.
Okay. And what if it goes the other way? What if the price is less than the net assets?
Gain. Conversely, if the fair value of the subsidiary, price plus NCI, is less than the fair value of its net identifiable assets, the difference is recognized immediately as a gain on the consolidated income statement. We credit the gain account in the EJE. This happens in a bargain purchase scenario. You essentially bought the company for less than the fair value of its individual parts.
A bargain purchase gain. Interesting. So those 6 steps cover the core elimination entry.
They cover the main components needed at the date of acquisition, yes. Debits TRR, balance sheet adjustments, identifiable intangibles, and goodwill, or credit to gain, offset by credits to the investment account and NCI. It should all balance perfectly.
That's a lot to process in one go, but breaking it down helps. Let's try to put this into action with that Gertie Co. acquiring Foxy Inc. example again to really solidify it. Gertie buys 60% for $69 million. Fair value of Foxy as a whole is $115 million. NCI is 40% of 115M, which is $46 million. Foxy's identifiable net assets are $100 million fair value, but $80 million book value, meaning CR equals $80. What's the goodwill, and how does that EJE look, roughly?
Okay, excellent scenario to walk through. First, let's confirm the goodwill. The total fair value of the subsidiary, implied value, is $115 million. The fair value of Foxy Inc.'s identifiable net assets is $100 million. So goodwill is indeed $115 million minus $100 million, which equals $15 million.
$15 million goodwill. Okay, now the EJE.
All right, the eliminating journal entry would look something like this. Debit common stock, AP2, and retained earnings, Foxy's CAR, for their book values totaling $80 million. That eliminates subsidiary equity.
CIR debited out, $80.
Debit balance sheet adjustments for $20 million. This represents the difference between Foxy's net assets fair value, $100, and book value, $80, bringing them up to fair value.
Balance sheet adjustment debited, $20.
Debit goodwill for the calculated $15 million.
Goodwill debited, $15 RAMs.
Now the credits. Credit the parent's investment in subsidiary account for the $69 million purchase price paid by Gertie. That eliminates the investment account.
Investment credited out, $69.
And credit non-controlling interest for its fair value, which we calculated as $46 million. That establishes the NCI share in equity.
NCI credited in, $46 million.
Now let's check if it balances. Total debits, $80 CAR plus $20 AM and $14 NJ plus $15 GW plus $15 million GW total credits. 69 Emmons in V plus 46 off M NCI, $115 million.
It balances. Perfect. That entry transforms the separate books into the consolidated view reflecting 100% fair value and the ownership split.
Exactly. It captures the essence of the acquisition method in one potentially complex journal entry.
That clear example really shows how everything comes together. Now, what about that gain scenario? Can we quickly recap the EJE for the bargain purchase example? Gertie buys 100% of Subco for $1 million. Subco's car book value is $800,000, but its fair value of identifiable net assets is $1.2 million.
Right, the bargain purchase. Here, the acquisition price is less than the fair value of identifiable net assets, $1 to M, no goodwill, instead a gain.
So the EJE.
Okay. Debit car, Subco's common stock, APIC RE, for $800,000 to eliminate subsidiary equity.
CRR debited out, $800K.
Debit balance sheet adjustments for $400,000. That's the difference needed to bring net assets from $800 K book value up to $1 to net and fair value.
Balance sheet adjustment debited, $400 pay. Total debit so far, $1 to enters.
Now the credits. Credit the parent's investment in subsidiary account for the $1 million purchase price.
Investment credited out, $1.
And the difference needed to balance, $1 to member debits versus $1 credit so far, is $200,000. That difference is credited to a gain on bargain purchase account, which flows to the consolidated income statement.
Gain credited, $200, and it balances. $1 to in debits equals $1 to emerged credits.
Perfect. That illustrates how a bargain purchase results in an immediate gain for the acquirer.
That's a great illustration. Now, thinking beyond the acquisition date, How does that non-controlling interest NCI we established continue to be presented and updated on the consolidated financial statements in later periods? It's not just stuck at its initial fair value, is it?
No, definitely not static. It changes over time. After the acquisition date, the NCI reported on the consolidated balance sheet continues to be accounted for using essentially an equity method approach from the NCI perspective.
An equity method approach for NCI. How does that work?
To calculate the NCI balance at the end of any given period after the acquisition, you start with the beginning NCI balance for that period, which was the ending balance from the prior period.
Okay, beginning NCI balance.
Then you add the non-controlling owner's proportionate share of the subsidiary's net income for that period. They get their slice of the sub's earnings.
Add NCI share of subs net income.
And you subtract the non-controlling owner's proportionate share of any dividends the subsidiary paid during that period. Dividends reduce their equity claim, just like it reduces the parent's claim internally under the equity method.
Subtract NCI share of subs dividends.
Correct. So beginning NCI plus NCI share of net income NCI share of dividends, ending NCI balance reported on the consolidated balance sheet.
That makes sense. It mirrors the equity method logic. What about the income statement?
Good point. On the consolidated income statement, remember, we include 100% of the subsidiary's revenues and expenses from the acquisition date forward. That's consistent with the single economic entity principle.
Right, 100% of the subs P&L activity.
However, to reflect the distinct ownership, the consolidated net income figure calculated after including all that activity is then segregated on the face of the income statement. It will clearly show the net income attributable to the non-controlling interest separately from the net income attributable to the parent.
So the bottom line is split to show who earned what.
Exactly. It provides full transparency on how the overall consolidated profit or loss is shared among the different ownership groups, the parent shareholders and the non-controlling shareholders.
That makes sure the overall picture is complete while still segmenting the ownership clearly.
Excellent. One final point for the acquisition method mechanics. What if on the acquisition date you don't have all the exact fair values locked down perfectly? What if some things are still estimates, maybe you're waiting on an appraisal, and those estimates change shortly after closing?
That's a very practical issue, and GAAP provides for it through what are called measurement period adjustments.
Measurement period adjustments. Okay. It's a recognition of the reality that obtaining precise final fair values for all assets acquired and liabilities assumed on the exact acquisition date can be challenging, especially for complex items or maybe contingent liabilities. So, the values initially assigned in that purchase price allocation are often provisional.
Provisional meaning temporary estimates.
Right. These provisional values can be adjusted during a specific measurement period. This period starts on the acquisition date and cannot exceed 1 year.
1 year maximum.
1 year max. It ends earlier if the acquirer gets the improved information needed about the acquisition date facts and circumstances, or if it becomes clear no better information will become available.
So what kind of adjustments can be made during this period?
During this measurement period, the subsidiary's assets and liabilities can be retrospectively adjusted, meaning adjusted back to the acquisition date to better reflect their actual fair values as they existed on the acquisition date. Also, if any new subsidiary assets or liabilities are identified that existed on the acquisition date but weren't initially recognized, maybe something was overlooked, they can be added.
So it's about perfecting the picture of the acquisition date, not reflecting things that happened after.
Exactly. That's the critical point. These adjustments are only for perfecting the acquisition date balance sheet based on information about conditions that existed at that date. Changes in value caused by events after the acquisition date are not measurement period adjustments. Those are separate post-acquisition events accounted for in the period they occur.
Okay. And how are these measurement period adjustments reflected? Where do they offset?
Crucially, these measurement period adjustments, the changes to the acquisition date fair values of assets and liabilities, are generally offset against goodwill, or potentially gain if it was a bargain purchase.
They adjust goodwill.
Yes. For instance, if during the measurement period you finalize an appraisal and find an asset's fair value is actually higher than provisionally recorded on the acquisition date, you'd increase the asset value retrospectively, and the offset would typically be a decrease in goodwill. If the asset's value was lower, goodwill would increase.
So it fine-tunes the initial goodwill calculation.
Precisely. It ensures the final goodwill amount accurately reflects the difference between the acquisition price and the finalized fair values as of the acquisition date. One related point. Adjustments to depreciation and amortization resulting from these changes are reported in the current period. The adjustments are determined. You generally don't restate prior period income statements for that impact.
Okay, the balance sheet adjustment is retrospective to goodwill, but income statement impacts are current. Got it. Let's try a quick example on that. Pathways Corp acquires Sidewalk Inc. for $500,000. Initially, based on preliminary fair values, they calculate identifiable net assets at $425,000 and record provisional goodwill of $75,000.
Okay, 75K provisional goodwill.
Later, within the one-year measurement period, they finalize valuations. They determined the property, plant, and equipment fair value was actually $15,000 lower than the preliminary estimate used. How does this adjust goodwill?
All right. If the PP&E fair value on the acquisition date was actually $15,000 lower, that means the total fair value of identifiable net assets was also $15,000 lower than the provisional $425,000. So the final fair value of net identifiable assets was actually $410,000. 425K, 15K.
Okay, net assets were lower.
Since goodwill is the acquisition price, $500,000, minus the fair value of net identifiable assets,
Okay.
$410,000, the correct goodwill from the acquisition date should have been $90,000. 500K, 410K.
$90,000 goodwill, but they only recorded $75,000 initially.
Exactly. So the measurement period adjustment would be to increase goodwill by $15,000 from 75K up to 90K and decrease the carrying value of the PP&E retrospectively to the acquisition date by $15,000. This reflects the more accurate picture based on finalized acquisition date values.
Perfect.
Yeah.
That clarifies how those adjustments work. Wow, we've covered a tremendous amount today.
Okay.
Seriously deep dive from the foundational concept of control voting rights versus economic influence with VIEs
The VIE model is key.
to the intricate details of the acquisition method, fair value, closing date, handling costs, contingent consideration.
Yeah, lots of details there.
And then the critical step-by-step consolidation estimates, the EJE, including those fascinating goodwill and non-controlling interest calculations and updates. It's complex, no doubt, but incredibly important stuff.
It really is. And if we connect this all back to the bigger picture, understanding these concepts is absolutely vital. It explains how some of the world's largest, most complex corporations present themselves as a single cohesive unit, even when they're juggling multiple layers of subsidiaries or really intricate financing arrangements.
Right. It's about that transparency.
Exactly. It's about ensuring transparency and providing a complete financial picture, even when ownership structures are messy. It highlights how accounting rules constantly adapt, or try to adapt, to reflect the underlying economic realities of these integrated businesses, hopefully helping investors and other stakeholders make truly informed decisions.
So what does this all mean for you, the listener? Well, the next time you see a headline about a major company acquiring another, or maybe you find yourself looking at a complex corporate structure in a 10K filing, you'll have a much deeper, more nuanced understanding of the financial mechanics behind it all. It's not just a headline. It's a careful, rule-driven process of integrating financial identities to paint that consolidated and hopefully truthful picture.
Which leads me to a final thought, perhaps a question to mull over. As businesses continue to evolve globally with increasingly complex cross-border structures, new forms of collaboration, and diverse financing arrangements that sometimes blur those traditional lines of ownership and control.
Yeah, things are always changing.
How might the core definitions of control and invariable interest, the very triggers for consolidation we discussed today, how might they continue to adapt or perhaps be challenged in the future of financial reporting to keep pace with that evolving economic reality? It's something worth considering as the financial landscape continually shifts beneath our feet.